Let's talk about how you can save thousands of dollars through tax deductions and tax credits. Now, this video will be especially helpful for year-end tax strategies as you think through how to reduce your taxes with deductions and credits. And we'll also cover all dollar amounts as they relate to the tax year 2022. But keep in mind that these numbers are subject to change by the IRS each year. All right, so what are tax deductions? A tax deduction is an item you subtract from your taxable income to lower the amount of taxes that you owe. A deduction reduces your taxable income, therefore lowering your tax liability. The lower your taxable income, the fewer taxes that you'll likely pay. Because these lower your taxable income, they're considered above-the-line tax savings. There are also two types of deductions, standard and itemized. The standard deduction is a flat dollar, no questions asked reduction in your taxable income. The amount you qualify for depends on your filing status. In 2022, if your filing status is single, your standard deduction is $12,950. If you file jointly with your spouse, your standard deduction is $25,900. This is the simple, straightforward way to file taxes. So that's standard deductions. Itemized deductions, on the other hand, include a range of expenses that lower your taxable income by taking any of the hundreds of available tax deductions that you may qualify for. The more you can deduct, the less you'll pay in taxes. When you file your tax return, you'll choose which one of these you'll use based on which type of deduction gets you the bigger tax break. It's that simple. If the value of your itemized expenses exceeds the standard deduction for your filing status, you will itemize your deductions. If the standard deduction, on the other hand, exceeds the total amount of your itemized deductions, you would use the standard deduction. Choosing one means you forfeit the other, so you need to make sure that you fully understand each type of deduction and all the options available to you. And it's worth noting that the standard deduction has increased in the last few years. So if you have a very simple tax situation, you're likely going to choose the standard deduction. Another thing to note here, if you are subject to the alternative minimum tax, the AMT, some or all of the itemized deductions that you claim may be reduced or eliminated. The AMT disallows deductions for interest on home equity loans, state and local income or sales taxes, tax preparation fees, and unreimbursed employee expenses starting in 2018. If you want to watch a video that gets more in depth on that, we'll link that below. So what are tax credits? A tax credit is a dollar-for-dollar reduction in your actual tax bill. Unlike deductions, which lower the amount of taxable income, tax credits reduce the actual amount of taxes owed. For this reason, tax credits are typically more favorable than tax deductions because tax credits reduce the tax liability dollar for dollar. While a deduction still reduces that final tax liability, it does so only within an individual's marginal tax rate. For example, if an individual in a 24% tax bracket would save 24 cents for every marginal tax dollar deducted. On the other hand, a tax credit would reduce the tax liability by the full dollar. There are three basic types of tax credits: non-refundable, refundable, and partially refundable. Most tax credits are not refundable, which are deducted from the tax liability only up until the taxes due are zero. Any additional credit greater than the tax owed is not paid out and cannot be carried forward to future years. Some common examples of non-refundable credits include the education credit, child independent care credit, retirement savings contribution credit, child tax credit, and the mortgage interest credit. Refundable tax credits, on the other hand, are more beneficial in that they're paid out in full. The taxpayer is entitled to the entire amount of that tax credit, even if it exceeds their tax liability. If a credit is refundable, you can receive money back as a refund with that credit. So if you owe $250 in taxes but qualify for a $1,000 credit, you'll get a check for the difference of $750. A popular refundable tax credit is the Earned Income Tax Credit, EITC. This is for low to moderate income taxpayers who earn income through an employer or by working as a self-employed individual and meet certain criteria based on income and number of family members. The other type of tax credits are partially refundable credits, which give the taxpayer a chance to offset a tax liability up to a certain threshold. A partially refundable credit, such as the American Opportunity Credit, provides up to 40% of the credit as a tax payment. When you claim this credit for educational expenses, Form 8863 separately calculates the refundable and non-refundable portions. For example, if you calculate a $2,000 American Opportunity Credit, a maximum of $800 may be reported as a refundable tax credit, with the remaining $1,200 reported as a non-refundable credit. YouTube is a great place to learn all the financial 101 lingo that we never learned in high school and college. I'm here to teach that, hit subscribe and follow along. And now this video is not meant to be tax advice, but instead is just an overview of key topics. Always consult a tax advisor about matters specific to your situation. Popular tax deductions and tax breaks. So whether it's a tax deduction or a credit, any reduction to your tax bill is a positive, right? Here are the most common ways to reduce your taxes. The student loan interest deduction. This deduction allows for college students and their parents to deduct up to $2,500 in student loan interest if your modified adjusted gross income is less than $70K as an individual or $140K as a joint filer. This is not actually an itemized deduction, as it's above the line and you can take this regardless of whether you use the standard or itemized deduction. For example, if you fall into the 22% tax bracket, the maximum savings from using the student loan interest deduction would be $550. Charitable donations deduction. This deduction is only applicable if you itemize, so it's an itemized deduction, as you can subtract the value of your charitable gifts, whether they're in cash or property, such as clothes, things from your closet, from your taxable income as an itemized deduction. Your charitable contribution will only qualify for a tax deduction if it goes to a tax-exempt organization, as defined by Section 501c3 of the Internal Revenue Code. These institutions include many religious organizations like the Red Cross, nonprofit educational agencies, museums, volunteer fire companies, and organizations that maintain public parks. Now, not all nonprofit organizations are 501c3 status, so if you want to take advantage of this deduction, you should absolutely verify the organization's status before donating. Property taxes deduction. You may deduct up to $10K for a combination of property taxes and either state and local taxes or sales taxes. So if you're a homeowner, you may deduct property taxes on your primary home, co-op apartment, vacation home, or property outside the US. If you're not a homeowner, you then may deduct property or real estate taxes on land, cars, RVs, other vehicles, and boats. You cannot deduct property taxes not yet paid or HOA fees. Homeowner mortgage interest deduction. In general, you can deduct the mortgage interest you paid during the tax year on the first $1 million of your mortgage debt for your primary home or secondary home. If you bought the house after December 15, 2017, you can deduct the interest you paid during the year on the first $750K of the mortgage. The eligible interest may include mortgage interest on your second home, points you paid on your mortgage, prepayment penalties, home equity loan interest if you use the funds to buy, build, or improve your home, and mortgage insurance premiums. There's a lot there. IRA and 401k contributions deduction. When you contribute to your pre-tax traditional 401k, you reduce your adjusted gross income, which as a result reduces your taxes by the contribution amount multiplied by your marginal tax rate. Now, the higher your income, the higher your tax bracket, and the more significant that your tax savings could be from simply contributing to your retirement plan. What's even better is that there's a higher 401k employee contribution limit for 2022, which means you could get an even bigger tax write-off to put money aside for retirement. Now in 2021, you could only contribute up to $19,500 to your 401k. In 2022, thanks to the cost of living adjustments from the IRS, you can contribute up to $20,500 to your retirement account. So let's say that you are a single earner who makes $200K a year, contributing the max $20,500 to your 401k each year. And since $200K puts you in the 32% tax bracket federally, your tax savings from the max contribution could be $6,560. Basically $20,500 times that 32% tax bracket. And that's not bad. And since your 401k contributions are made pre-tax, your employer will not include these contributions in your taxable income. So if you made $200K last year and contributed $20K to your 401k, you would only end up with $180K in taxable income. Self-employment expenses deduction. There are many valuable tax deductions for freelancers, contractors, and other self-employed people who work for themselves. We have another video on this that we'll link, but here are a few big self-employment tax deductions to remember. The home office deduction. If you run your own business from home or use it as a part of your business, you could deduct a portion of your home office expenses. You could deduct a portion of your mortgage or rent, property taxes, the cost of utilities, repairs, and maintenance, and similar expenses. Now generally, this deduction is only available to the self-employed. Employees typically cannot take the home office deduction if they're just working for a standard company and they work from home. The car deduction. If you use your car to run your business, such as driving to meet vendors, you could deduct some of those auto expenses from your taxes. In 2022, you could deduct 58.5 cents per mile that were used for business purposes. So if you might take advantage of this, keep a mileage log throughout the year. Retirement savings again. If you contribute to a retirement savings account with business income, you could deduct these contributions from your taxable income. Now, many small business owners use a solo 401k or SEP IRA to save for retirement and offset taxes due each year. For example, you could also deduct contributions to a solo 401k of up to $61K in 2022. Add an extra $6,500 if you're 50 or older, or 100% of earned income, whichever is less. If you want to learn more about which type of retirement plan is best for you as a self-employed business owner or freelancer, we will link that below as well. We have a lot of resources for you. If you want to learn more about taxes, keep watching this next video here. I'm Tony from Wealthfront. Thanks for much for watching.